Welcome to FinStreet. We have with us Mr. Viral Shah, who is the Senior Vice President at IIFL Capital, who tracks NBFC sector very closely. Welcome to the show, Viral.
Thank you,
now,
Abhishek.
how do you find the Q3FY25 results for both NBFCs and HFCs, and how do you see them panning out ahead?
So, see, I think the third quarter was kind of, I would say, a mixed bag. You had the growth slowdown. In some pockets, it was anticipated. Some pockets, it was a surprise. Like in case of an HFCs, there were certain micro markets which were relevant for those players. They saw some disruption in terms of the disbursements because of the local state government issues, in terms of property registration. Whereas in case of the other NBFCs, the growth slowdown, I would say broadly speaking, was on expected lines, as we discussed in our previous episodes, on the base gradually catching up, and then the effect of the broader economic slowdown playing out eventually. In terms of the performance, I would say apart from growth, the profitability perspective, the NIMs broadly were either stable or they came under pressure in different subsegments or players. And I think from a credit cost and asset quality standpoint, this quarter witnessed another, I would say, a period where you had relatively more, say, asset quality stress, and probably in some pockets we are still far away in terms of improvement on the asset quality front. Net, it was a mixed quarter. Going ahead, the way we see it is we are going to be selective within this space. Some companies, some pockets, it seems better. Some pockets will take some longer to recover, whether it's an MFI or unsecured segments piece. Whereas in case of a vehicle financing, we should start seeing the seasonal improvement from here on.
RBI is boosting liquidity now. They have reduced the RWA requirement, and also other aspects have been taken care. So how do you see boost to NBFCs with respect to liquidity flow from banks to NBFCs going ahead?
So there are two aspects to this. One, as you mentioned, the liquidity flow, and the second is also on the cost of front side. On the first point, I think the reduction in the risk weight of bank lending to NBFCs, I think it's a pretty much welcome move. Especially, it's going to benefit the smaller NBFCs, because back then in November 23, when RBI increased the risk weights, apart from on the unsecured consumer side, even this increase kind of led to drying up of capital, the financing for smaller NBFCs who are hitherto not been as active on the capital markets front. That is something that should ease out. Having said that, does this translate automatically into a better cost of funds? I don't think so. In fact, our conversations with both banks as well as NBFCs, including the smaller ones where this benefit comes through, is that given, yes, RBI has done a lot on the liquidity front, but still the liquidity remains tight. Till the time that kind of eases out, we will also not see the pass on as much of even the rate cut that has come through. So potentially in the 1Q of FY26, is when one should start seeing some benefit of that rate cut coming through. But yeah, for the smaller NBFCs, the cost of funds is not as much of an advantage because of this move, but more of the availability of liquidity.
Now, we are witnessing slight hiccups in certain pockets, right? And you spoke about the micro part of the segment getting hit. I remember some of the, lenders are showing pain, especially in the micro lab portfolio. So how do you see this pain, and do you see it spreading over to secured part, or do you see unsecured part pain still some time ahead?
So see, the unsecured, or rather, let me put it this way, the micro lab which is there, right? Predominantly a large part of it is the secured piece. And on that secured segments also, you are seeing actually asset quality deteriorating. So it's a function of multiple things. There is an overlap with the MFI customers, even on the micro lab piece. Yes, their collection efficiencies have also dipped. But of course, it is nowhere to the extent where an MFI players are witnessing the kind of pain, given the fact that it's a secured product being lent against the security of the house of the borrower that the borrower is living in. So to that extent, we are seeing the deterioration, but it's not to the extent where an MFI is there. But this is something that will probably continue for next few quarters is what we see.
One of the key highlight in this quarter was the rise in opex or operating expenses of all the lenders. So lower provisions, led to healthy PAT growth for them. So how do you see, or what have you witnessed with respect to opex rising in Q3 and panning out ahead?
So see, on the opex front, it's a function of, I would say, two things. A lot of NBFCs are getting into the newer segments. People are investing in that. And also at the same time, they are expanding geographically in terms of, say, their new product offerings or setting up branches in new geographies. That's the one aspect to that. The second aspect is the continued investments in tech. The requirements, both the regulatory as well as the market requirements are such. These are the investments that one needs to keep making. So both a combination of both of those things has what has led to even OPEX growth being relatively higher, I would say.
Well, how do you see the valuations for the NBFC or the HFC sector as well? And what are your top picks at IIFL Capital?
Sure. So see, valuations, I think in pockets of NBFCs, they have derated meaningfully. Those are the ones where we are seeing a lot of stress. There are some pockets, I would say well-known NBFCs like Chola or a Bajaj, where valuations, in fact, both of those stocks have outperformed in the last 2 months, and where the valuations have not corrected that much. In terms of the outlook overall, I would say selectively we are looking at names who are relatively better placed to navigate this environment, who have lesser exposure to, say, the unsecured piece, or the ones who had tightened their filters, say a year and a half back. In terms of housing finance companies, I think the next 1 year, 1.5 years is relatively going to be a bit challenging because the rate cuts are negative for them.
Well, thank you so much for your time at CNBC-TV18 speaking about the NBFC sector's Q3 FY25 performance and way going ahead.
Always a pleasure. Thank you.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC-TV18 and CNBC-TV18.com.
Hey, thank you for watching this on CNBC-TV18. Hope you liked it. For more such interesting news and updates, follow CNBC-TV18 on all the social media platforms.